those benchmarks have fallen apart again, and we've seen a widening of the differential between the two, and basically U.S. crude prices have been trading at a deepening discount, widening discount to other international benchmarks. And that's partly because of new production, partly because of the seasonal decrease in runs in the U.S. And logistical constraints, which are preventing U.S. oil supply from being evacuated and traded internationally. In terms of demand, not too many big developments, but something that's surprised the market has been the unexpected relative strength of European supply, European demand. There's been surprisingly strong demand from a number of European countries these last few months. That has caused some upward revisions of current demand estimates. Looking forward to next year, we do expect, generally speaking, a little bit of an increase in the pace of demand growth because we do expect the economy to continue to recover. But this is at a fairly subdued pace. So we now expect about 1 million barrels a day of new demand for 2013 and about 1.1 for next year. In terms of supply, big developments have been a major drop in OPEC supply, so collapse in Libyan supply and problems with Iraq. There's been many problems affecting Iraqi supply, which had grown last year, but now has been contracting again, has been slowing down. There's been some efforts to improve logistics in Basra, which is the main producing region in Iraq, but those efforts have been slowed down by all kinds of problems. There's been attacks in the north that have been slowing down exports from the Kurdish area and from the Kirkuk area. So less production there and less exports than expected. The call on OPEC, on the other hand, the amount of oil that the market needs from OPEC to balance demand has been pretty stable in terms of where it stands compared to forecast. So really, now the problems with Iraq and Libya until recently were partly offset by very high production from Saudi Arabia. Saudi has been producing very high rates, over 10 million barrels for 3 months, but just recently slowed down again and throttled back to under 10 million barrels per day. One key factor behind that, the seasonal slowdown in domestic demand in Saudi Arabia, but possibly also the lack of a market. Iran has been